In this video we are going to talk about crypto has crashed, can it bounce back? So before starting this video, like this video and subscribe to our YouTube channel for future updates. You have probably seen some unrest in the Bitcoin industry, even if you don't live and breathe it. What's truly happening isn't always clear from the eye-catching headlines about missing apes and falling stablecoins. Gradually, then all at once, like so many other things. Consider Bitcoin, the first cryptocurrency, which accounts for nearly a third of the market's value. Since the end of March, the price of a single Bitcoin has been steadily declining along with a general downturn in the technology industry. That is reasonable. Similar to buying any other tech stock, investing in Bitcoin is, in some ways, a bet on the potential for more technical change. The entire sector started declining as a result of rising inflation stifling post-pandemic growth on both sides of the Atlantic and a nebulous perception that irrational exuberance had resulted in an overvaluation of IT in general over the previous several years. The dam eventually broke in early May. It decreased faster in a week than it had in the month before. Contagion from the disastrous failure of another cryptocurrency project named Terra, which had previously been valued at more than $50 billion but finished the week practically worthless, was the immediate reason. Other cryptocurrencies also lost value along with Terra. As investors anticipated that other similar initiatives would follow, the value of those projects first fell. Panic then spread throughout the entire sector, and even relatively high-quality tokens like Bitcoin itself experienced declines. It took until mid-May for the drop to stop, and while the market has since stabilized somewhat, there are no signs that it will soon climb back to its previous month's highs. According to one chief executive, a crypto winter could be upon us. And that is the upbeat perspective from within the industry, where the pessimists believe that this is the beginning of the end. With high inflation undermining the attraction of high-growth, low-profit investments and a string of punishing admissions from the major corporations creating fundamental concerns about the limitations to their prospective expansion, tech equities as a whole have been crushed in recent months. Fans of Bitcoin may push the idea that their currency is a kind of digital gold, with a finite supply that makes it an efficient inflation hedge. However, in reality, the chance for a digital revolution decreases as economic prospects worsen, inflation increases, and Bitcoin prices plummet. In addition, it appears that retail investors dominate the cryptocurrency market, treating it as a cross between traditional day trading, already a stunningly risky way to invest money, and pure gambling. These investors might be forced to sell part of their holdings when growing expenses bite, further damaging the sector. A stablecoin, or cryptocurrency token with a set value of, typically, $1 was the goal of the Terra project. It's not new to use stablecoins. The two most well-known in the market are Tether and USDC, and they work similarly to banks in that customers give them cash and receive stablecoins in return, which can then be exchanged for cash at any time. The problem with the reserve-backed model is that you have to trust the stablecoin's provider to keep the money secure and accessible rather than betting it all on red in Las Vegas to turn a quick profit with other people's money. The corporate supporters, venture capital firms, and successful companies appear to be the biggest beneficiaries in all of this. There has been a long-standing drive for a new kind of stablecoin that will maintain its value algorithmically rather than through the actions of bankers, because just trust us is anathema to the cryptocurrency industry. One of such attempts was Terra. A pair of currencies, of which Terra is supposed to always have a value of $1, while Luna is supposed to float freely. If the price of Terra rises too much, Luna owners are encouraged to print more because they can always convert it for $1. Additionally, Terra may always be converted into Luna for $1, so Terra holders are enticed to destroy the currency to drive up its price if it falls too low. The system only functions if Luna has any value at all, which is the problem. Thanks to an aggressive promise to pay 20% interest on deposits held in the currency, it did for a while. When investors began to withdraw their funds in the midst of the fall to cover losses elsewhere, it abruptly stopped happening. When investors converted Terra into Luna, the price of Luna dropped, which led to the next redemption, which further decreased Luna's price, and so on, creating what is known as a death spiral. The Luna coin's value dropped from $80 to roughly 1/1000th of a cent in a matter of weeks. The test was completed. The winners and losers are who? The answer is straightforward on the surface: those who sold their cryptocurrency holdings in early April are the winners, and those who bought them are the losers. It happens frequently enough in this industry that there is even an acronym for those who are still standing when the music stops. HODL, hold on for dear life. This acronym implies that the boom times will return and that only those who don't panic and sell at the bottom will profit in the following stage of the cycle. However, there are differences. Those who purchase shitcoins, low-effort projects where nearly everyone involved acknowledges that the goal is simply to buy low, sell high, and leave someone else picking up the pieces, have lost much more money than those who held blue-chip cryptocurrencies like Bitcoin and Ethereum, which have only lost about half of their value from the peak. Similar to individuals who were able to convert their cryptocurrency into cash, those who were able to withdraw their funds into a stablecoin that withstood the volatility are in a nearly same position. Similarly, if you purchased a Bored Ape NFT during the height of the market, you might have difficulty reselling it for the whole amount you paid for it, but it's still rather simple to flip it for more than £10,000. Not if you purchased, for example, a screenshot of Jack Dorsey's very first tweet on Twitter, which you paid $2.9 million for but is now only selling for $14,000. The corporate sponsors of sector venture capital funds like Andreessen Horowitz and the successful startups that have given rise to numerous boom/bust cycles appear to be the biggest winners in all of this, though. Giving yourself the power to print something for free that everyone else is eager to purchase is ultimately the only thing better than purchasing low and selling high. The blockchain concept, a decentralized ledger that monitors ownership of digital assets without giving any one person or organization authority over the network, is the key innovation that underpins everything in the cryptocurrency business. Other common features include the use of cryptographic wallets, which allow assets to be held in a way that prevents any transactions without the secret key of the account holder, and proof of work, a method of securing a blockchain by requiring enormous amounts of energy to be burned every second, in order to economically deter attackers from trying to break the system. In different ways, each of those technologies has faced criticism. For instance, proof of work is to blame for the astounding carbon footprint of the Bitcoin network, which is equal to that of the entire country of Thailand. Meanwhile, the blockchain itself serves as little more than a painfully slow and ineffective database in any situation where decentralization isn't the primary benefit. But in other situations, these technologies continue to be extraordinarily potent. When there is no centralized entity to enforce the laws, any situation where a government may try to halt economic activity, for example, becomes considerably more difficult to enforce. That might include individuals working to advance democracy in states with strict capital controls, as well as ransomware merchants extorting money from hospitals and schools in countries lacking extradition treaties. The Bitcoin industry has previously endured disastrous disasters. It's horrible, but winter comes before spring, and that's what spurred the most recent discussion about us entering a crypto winter. Investors are urged to wait for the market to defrost and simply sit this one out. The possibility that things could change this time is cause for pessimism. In general, the growth of the cryptocurrency industry has come from attracting ever larger numbers of new users. However, this most recent bust can be so significant and pervasive that it will be difficult to acquire any new clients. And soon, people who keep their funds in cryptocurrencies will have to sell in order to pay their real-world costs, but they won't know who to sell to. The pool of ignorant cash to buy in the next time around will be quite little if everyone in the developed world either lost money in the crypto meltdown or knows someone who did. However, effort on creating consumer goods continues in the interim. Perhaps someone will have created a play-to-earn game that is truly entertaining or an NFT that millions of people would like to acquire. The time is running out in any case. What do you think about this video? Do let us know down in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.